Joining us for a closer look on what's playing itself out on the market scene is Anthea Gardner from Cartesian Capital. Anthea, thank you for your time and good afternoon.
Hi, Nalatanda.
Well, Anthea, we could start off by maybe just reflecting on markets. We are seeing more red than green in Europe and here at home. What is driving these sentiments today?
Yeah, it's a bit of a dull day, isn't it? Our market is currently flat. I think everyone's just sitting on their hands ahead of the US CPI print. We did have mining production out about half an hour ago. Very disappointing, increased by 0.6% year on year, but the market was expecting a 4.9% gain. And that was down from November, which was a 6.9% advance, so really not great. And so much to say about it. I don't know if I should bring in the logistics issue and, reserves and how much product are they sitting on that they can't get out. So I think that's probably it. And also, so the commodities that did well were PGMs, coal and chromium ore, while iron ore production was down 18%. And that's just kind of disappointing. I think at least we're getting some PGMs out of the ground. The commodity shares, though, slowly reacting. They were positive, nothing huge after these mining production numbers came out. So I think people were expecting not a great number.
What we actually see, and there is a consistent hammering of those commodity stocks. I'm wondering what kind of environment would see a recovery for them. The likes of Implats, Amplats, they really have had a very difficult ride.
John Olatanda, and I think it's a bit like the oil price, actually. They're torn between, is China going to grow above 5% this year or not? So the oil price it's being held up because we've got Red Sea logistics issues, and then we've also got war in the Middle East. And it's being pulled down because they don't know how much China is going to grow by the uncertainty of Chinese growth. And I think the commodities prices are kind of in that nowhere land almost.
It's also interesting, just the amount of uncertainty we're still dealing with in 2024. Anthea, I'm wondering, for instance, we're expecting this U.S. inflation print today. Markets are waiting for it with bated breath. But we know that the U.S. Fed is still very hawkish at this point. Is it possible that we might get a print that, again, leads us to going ahead of the U.S. Fed?
You're looking for a change in sentiment. So I think investors are exactly like, what is going on here? We're expecting 2.9% headline number. For the first time since March 2021, it's going to be below 3%. And I don't know if you remember, a while ago, the Fed said they may consider looking at an average below 3%. I don't think 2.9% is going to make a huge U-turn in their higher for longer thesis. But the market is going to look forward for or maybe anticipate some dovish language. The next meetings are March the 20th. So Fed fund futures are indicating only a 15.5% chance of a cut at that meeting. And then slightly tilted towards a 25% basis point cut in the May meeting rather than a hold. So market's still quite positive, I think, put it that way, yeah.
And then I was also ask you about what we're seeing here at home with our own inflation picture. Of course, we can't cut until the US cuts, but you mentioned Transnet. There are a lot of things happening here at home, Anthea, that actually don't look encouraging for our inflation picture, for our risk picture, and might have the Reserve Bank, which we know is quite a dovish MPC that we're seeing, their hawkish MPC there rather, really sticking to its hawkish guns.
So this idea that we can't cut before the US cuts an interesting one. We did raise interest rates before the US did, right at the beginning of this cycle. So I'm not sure that holds water. But as you say, our MPC is very hawkish, and they understand the impact of inflation in an economy where there are so many poor. And their job is not GDP growth. They understand that high interest rates are affecting the consumer. We don't have GDP growth. It would be nice to get a rate cut, but that's not their job. And so I don't know. It's difficult to say. And Lusetio said the last time, 4.5% is the midpoint. Kind of end of story, right?
I must also ask you about what we're seeing in Europe. It's a very, very interesting picture there. Germany, the biggest economy in that part of the world, really seems to be battling. I think we're even seeing strikes coming out of that part of the world right now. I think unprecedented strike action. What's happening with Europe here? It seems to have been more of a strenuous picture than what you anticipated. Also, can you find out how markets are perceiving that environment?
So today, the European market, same as ours, little changed. Everybody's trading very carefully ahead of, this US CPI number. But historically, or kind of in the last year and a half, I think, Europe has just not performed. It's been kind of the sick economy of the globe. Very disappointing, actually. And I think those strikes are just people frustrated, and it doesn't take much for the French to strike. So can you imagine higher interest rates hitting their pockets? That's not going to work for them.
I want to speak about stocks now. Nvidia, we're seeing a stock continuing to rally. Anthea, I'm one of those people who thought, in 2023, this stock ran and it possibly can't run anymore. But I've been proven wrong already, and it's only February. This AI picture, this AI story continues to be one that bears a lot of optimism.
Yeah, how many times have we read in the last couple of days that Tesla is going to fall out of the Magnificent Seven, right? They're not an AI stock, so are they? Nolitanda, I think you might have asked me this the last time. I'm not sure what they've run so hard. How much harder can they run? I think they can still go. I think there's still room for more upside in the share prices. Difficult to say, right? Look. If on the 20th of March, the Fed comes out and they're vaguely dovish about interest rates, I think you'll see the whole market rally.
And that's what we were kind of waiting for. We're like sitting ducks, aren't we, Anthea? And I didn't expect that we'd spend 2023 looking at inflation and 2024 just looking at what is, happening with interest rates. But all of it looking at central bank watching. It looks like it's just the theme of the last 5 years or so.
It just feels like it, Alejandro.
Anthea, I'm keen to get your stock pick, but before we do that, I'd like us to reflect on counters that have found favor with your industry peers.
Stock pick is Toyota, who is the leader in that field. They were markets were very miserable about them 2-3 years ago because they weren't going on the EV bandwagon. That's turned around. Great results a couple of days ago. EV sales declining, hybrid coming into fore, and what excites me most is the battery technology that they're designing at the moment, which is away from your lithium ion type of battery to lithium iron phosphate, which is a solid state battery, which can be quite a revolution as far as both hybrids and EVs are concerned. And they're the biggest car seller in the world. You can't go against that. These guys know what they're doing.
I'm very dirty tonight, Julieta. I'm buying Sasol.
Very dirty indeed.
Yeah. So it's the absolute ESG nightmare that they've gone through lately. It's not over, and I just think a lot of institutional investors are throwing it out of the portfolios because of the ESG problems that they've had. That's one. Two is chemical margins. I think chemical margins are already so thin at the moment. And then thirdly, obviously energy producers all over the planet, all integrated oil companies, etc. Those guys are trading at low multiples for some reason, because apparently we're all moving to EVs. I just don't buy that. We've done our homework. Unfortunately, we're still going to sit with fossil fuels for a long time to come. 5 years from now and 10 years from now, the world is going to be burning more fossil fuels in one way or another. And Sasol will be one of those. And it's sitting at a very low multiple. If you just extrapolate the last 6 months' earnings, sitting below a 5 price earnings ratio.
Yeah.
Maybe they take a each year or there, but there's proper margin of safety in the valuation here. And they will spend some money in coming years addressing that E in the ESG rating. There is some ways that they can decrease their carbon footprint, etc., or just push up the S&G part of the ESG equation.
trees that don't grow to the sky. S&P has been going up, and all because of this nice earning stuff like that, and mainly from the tech. We think at some point there need to be some consolidation. So I think that the likes of S&P at some point, it has to consolidate. So we rather short it, and there is an instrument called the SPXU. So that's what we will go for it for now.
All right, Anthea, keen to get your thoughts on some of those, Toyota, Sasol, and that SPXU.
Toyota, that's a good buy. Just like the cars, reliable, consistent performance, the company's moving with innovative trends in the industry. Yeah, I think you can't go wrong with that one. Can't agree with Sasol, I'm afraid. You know, I understand that they've had a tough time of it recently on all fronts, chemical prices, ESG activists, bad capex spend. And the share looks cheap, but if no one's buying the share and no one's believing that they're going to have a turnaround, I just cannot see a near-term catalyst for a higher share price. The S&P 500 or SPXU, it's a brave man that shorts a market, especially ahead of the US CPI number. You know, the Bank of America survey recently showed that global fund managers are the most bullish they've ever been, or they've been in 2 years, not ever, for sure, not ever. And they've decreased their allocation of cash from 4.8% to 4.2%. And that money is going to flow in the market. As I said earlier on, a hint of dovishness, and this market's going to rally.
Keen to get which counter you're liking today.
So, Alessandra, I'm very nervous about the equity market at the moment. And just because it's uncertain, I just don't know where this US CPI print is going to be. And it's kind of on a knife edge, you know. And so I'm not in the habit of gambling red and black, so I'm going to go for, because we've got high interest rates at the moment, I want exposure to fixed income products. I'm afraid I'm going to choose my own unit trust, the Cartesian money market unit trust. It's currently yielding 9.35% per annum, very little volatility. We've got 25% exposure to fixed rate notes, so decent yield. If they do cut interest rates in the next year, for example, then at least the fund is positioned to outperform in the short term because those higher rates will kick in, whereas we won't be exposed to the floating rate, which should come down.
Fantastic. Always a pleasure speaking to you, Anthea. Thank you so much for your time today. That was your Midday Markets Update with Anthea Gardner from Cartesian Capital.